everyone. It's great to see everyone here. This is our 4th Metals Investor Forum. It's really exciting to see the interest growing and the room so full first thing on a Saturday morning. I'm just going to jump right in. Obviously, the question on everyone's minds right now is what now? We had a very big week politically and for gold. So what does it all mean? So volatility, for sure. I mean, we saw gold spike dramatically during the election count, then come off more than most expected. That knee-jerk reaction that was widely predicted should Trump win, you know, the $100 gain in short order, that clearly didn't materialize. And in fact, we saw the opposite go on. We saw gold futures fall, 6%. The gold price came off notably. And some of the majors, took significant hits, like they're noticeable from a technical perspective on their charts. I mean, to see silver wheaten down 13%, that's pretty big. So what is going on with that? Well, clearly the main thing is Trump. The main thing I have to say here is that the markets reacted in what I would describe as an incredibly rational way, which is that knee-jerk expectation that gold was going to shoot up because, Trump, we don't really have any idea what Trump is actually going to do. He outlined approximately 17 million ideas during his campaign and gave almost no detail on any of them. So over the next 2 months, we'll find out what the man actually plans on focusing on during his term, right? And that, amazingly, is what the market, in my estimation, is waiting for. Some facts, some information on what Trump will focus on. Now, Trump understands that a surge in the big boards is only going to help his popularity. So he knows that that surge is coming from the idea that he's good for business. I expect, therefore, that some of his focus will be on the planks of his platform that feed that idea, which is cutting corporate tax rates, cutting some income tax brackets, rolling back regulations, and pouring money into infrastructure and the military. So I expect those things to be there, and those are foremost for the market. That's what's propelling the U.S. markets forward, and of course the U.S. markets going forward is a little bit difficult for gold because that distracts the generalist investor from the yellow metal, from the safe haven, and sends them back into the big boards. The thing is, Trump, if those do become his foci, which I expect, he needs a lot of money to fund that. And you may have noticed that the first 2 points on that list of things that I expect him to do are cutting taxes. So I think people are pretty familiar with the idea that he plans on spending a lot and bringing in less for government. That clearly doesn't work. He's going to need to issue a lot more bonds to try and support that plan. Well, of course, what happened to bonds over the last few days? Yields have spiked. So this is not, some have argued that this is because people are expecting growth. No, bond yields aren't spiking because there's an expectation of growth. There may be ideas about U.S. economic growth, but bond yields are spiking because it's a reaction to trillions of dollars more debt in the first few years of a Trump presidency. So if spending is going up, there's this ratio, right, where you take the amount that you're spending, you take away the amount that you're actually bringing in, divide that by the amount you're spending. That's sort of a ratio that helps you look at what your income versus outcome or output looks like. And this ratio is set to rise. And I mean, there's a lot of arguments about what the number needs to hit before inflation goes crazy. But, 30, 40, those numbers are very reasonable. 30 or 40% is a very reasonable number in the early years of a Trump presidency. That kind of inflationary perspective is going to have bond yields really high. So what does that mean? Well, where is Trump going to get his money is a good question. Are there going to be a bunch of that positions bonds as being a far riskier investment than they have been for a long time. Bond investors have already seen about $1 trillion in losses on the price side since the election. That's pretty significant. So this whole question of there may be economic growth under Trump, that is obviously, we do not know. We'll have to see how that all pans out. But the situation that we're looking at is a lot more spending and a lot less money coming in. So Is that good for gold? It absolutely is good for gold. We're talking about a weaker US dollar, we're talking about inflationary pressures, we're talking about a lot more US debt. And then in the context of that, usually when you're in an inflationary situation, you expect interest rates, like nominal rates, to go up. The near term on that, I'll get to in a minute. I do expect them to go up in December, but that's before Trump gets into power. After that, are nominal rates going to go up under a Trump presidency? Well, he certainly has said that he doesn't think they should. We'll see what happens. At the end of the day, though, he can't really afford to increase them because has anybody noticed how much debt the U.S. government is already trying to service? And now they're going to issue more that they'll need to service. So interest rate hikes are going to be a really contentious issue under a Trump presidency. But if inflation is rising and nominal rates are not, then real rates are going to fall. And that is very bullish for gold. That is the fundamental driver for a gold bull market, is real yields falling. In that context, we've already seen the Bank of Japan do something pretty interesting, which is take their 10-year treasuries and cap the yields. So the yields aren't allowed to go up on certain 10-year Bank of Japan treasuries. Now that is a really interesting thing, and that, first of all, it demonstrates sort of the Bank of Japan's desperation to hold on to their debt load and be able to manage it. But that's the kind of requirement that we might see America facing, given this spending versus tax receipt dilemma that they're facing. Then, of course, the U.S. markets. We don't know what's going to happen to the U.S. markets. There's lots of arguments from a big picture perspective, sort of outside of Trump, that suggest that there's a market downturn coming. One of them is simply just the longevity of the bull market, right? These things don't usually last as long as it has already lasted, let alone longer. There's lots of metrics that suggest that U.S. stocks are overvalued. A change of guard in Washington is almost always accompanied by a stock market downturn. Magnitude varies, but some kind of stock market downturn. And then, of course, if yields do go up, which they're certainly doing, it's going to be difficult for companies to raise debt, and that they have been living on a lot of debt in terms of fueling their investments. So there are a lot of fundamental reasons for a U.S. market downturn. A U.S. market downturn is great for gold because of that, because of the fact that that generalist rotation, that rotation of the generalist investor from the U.S. big board into gold is kind of like the fuel that feeds a fire, right? The fire's already there, but it certainly pours extra fuel in it for that to happen. The timing of that will depend on Trump. So then in the near term, what is the sort of timing outlook right now? What are we looking at? As I say, the markets are basically erring on the side of optimism right now when it comes to Trump. We don't know what he's going to do yet, so we're just going to hope that it's good for now until we're given more information. And that information will dribble out, right? Over the next 2 months as January 20th approaches, he's going to make some statements about what his foci will be. He's going to appoint key personnel to his team. This will help us get some idea about how he's actually going to act in his term. So that information will play a role. But uncertainty about Trump, just because the markets increased in the last few days doesn't mean that the markets are 100% happy with this idea. There's a lot of unknowns ahead. Volatility is going to increase. As January 20th approaches, volatility will rise. I think there's no doubt about that. And volatility is also a friend for gold. So we have this sort of window right now between now and inauguration. And interestingly, that window lines up quite perfectly with the window that we're already in the context of a gold correction. So gold obviously gained dramatically in the first part of the year and has come off in the last few months. Gold corrections, and I'm sure Jordan tomorrow will speak to this, gold corrections following a sharp rise like we saw usually last in the order of 5 months. They're not usually a single down, they're usually sort of a W shape. So we've seen the first down, we got a bit of a rise, then we're on our way back down again. It actually all fits in quite nicely with this idea of a bit of a lull as January 20th approaches, and then we'll see what happens. In the middle of that lull, of course, we still have the December Federal Reserve meeting. I think that Trump's victory has almost guaranteed that we will get a rate hike in December. Janet Yellen's entire term was a giant monetary experiment, and she wants to be able to leave office, and this is me supposing that Trump will replace the chairwoman, which is, who knows, might well happen. He certainly isn't a fan of Janet Yellen. But if she's able to raise rates, you could make the argument that that says that her giant monetary experiment has been a success, right? She'll raise rates saying that growth is good and unemployment has improved, and therefore, look, we did it. We're raising rates. She also desperately wants to raise rates so that there is a cushion because of this likelihood from time frame and overvaluation and all of these things that a recession could be coming. So I think the odds of a rate hike in December are very good now. So gold is going to react to that. Gold always is going to react to that. So we have a downturn, I think, at least until that event is over. December 14th is when that meeting happens. And you can see that the market agrees to me to a large extent. We're still pricing in the odds of a rate hike at over 80%. They fell for a bit right after the election, and then they just rose back up again as people came around to this line of thinking. Once that rate hike is over, then all of a sudden Inauguration Day becomes the next thing. And that's going to really start pushing things up again for gold, is my expectation. Now, I could be wrong. Trump is a huge variable. There's a huge amount of uncertainty in that. But I do believe that the fundamentals of a Trump presidency are very good for gold. Within that, we're in this, before Trump happened, or was actually won this week, we were already in the context of a gold bull market that was catching its breath. These are the sort of the fundamental reasons why that gold bull market still makes sense outside of Trump specifically. We've got real rates globally that are low or still negative, and perhaps now, like I've said, going that way in America. Debt loads, bonds is, as I have referenced a little bit here, the bond situation is really interesting. There's a huge amount of junk bonds in America that were issued sort of starting in 2010. That's when the issuance really shot up. So a lot of those junk bonds are coming due in the next little while, few years for sure. If interest rates start to rise, if yields are already going up, servicing those junk bonds is going to be difficult, and it's not strong corporations that issue junk bonds. So servicing those yields is going to become increasingly difficult. So there's a lot of uncertainty, there's a lot of reasons to be cautious about strength in sort of the general U.S. equity picture. Then, of course, we have a U.S. dollar that I think will be challenged under Trump, the classic cyclicality of gold, and therefore gold offering what is real security and value amidst all of this uncertainty. Within that, I'm going to sort of just go through the next section quite quickly. These are the kinds of opportunities that you can play in a gold market. The fact that you're here today means that you understand these opportunities. So I'm not going to spend a lot of time on it. I want to be able to get onto the companies that are here because it's a really incredible group of companies that are presenting at the conference, and for them to each only have 10 minutes is insufficient, so definitely spend time with them outside because they have a lot more than they can say in only 10 minutes. Oh right, this was, I'm getting ahead of myself. Despite the correction, these are just some charts, right? So what's the characteristic of a bull market? It's higher highs and higher lows. So obviously these are just some charts, but there's a one-year gold chart, a one-year zinc chart that looks hot. The GDXJ still looks pretty good even after the correction. Sure, it brought it down to that low that we saw in June, but we could still maintain the higher highs and higher lows or be within that ballpark. Few more. Silver, again, still pretty much within the higher highs and higher lows context. Two examples of stocks, gold stocks, that are still within the higher highs and higher lows context. So there are lots of reasons to believe that the bull market is still intact. Another one would be interest in gold ETFs. Buying has remained very strong, despite the price correction leading into Trump. There's still a lot of interest in ETFs, and therefore their buying is still strong. So support is there. This correction is an opportunity that is really present over the next month. So the timing of this conference is fantastic because I think it's the next month where you get this second chance. If you didn't position all in last December, which most people didn't because it was the end, we didn't know that it was the end of a terrible, terrible, terrible bear market, and therefore we were all very cautious. This is sort of your second opportunity, right? What should you do? like I say, the types of opportunities. Major producers are obviously offer the most direct leverage to the price of gold. So the lowest risk leverage to gold, that's great. They offer that primarily because they benefit from big buying, by which I mean sort of ETFs, indexes, and funds, right? That's what fuels them being that obvious leverage to the price of gold. Context says that whatever gains happened already this year, these majors still have a lot left to give, right? So this is Kinross. It did gain 230% in the first 8 months of the year. Great, that's amazing. It's off now 40% from that re-entry opportunity. To get back up to where it was in the previous bull market, we have to gain almost, 350%. So lots of opportunity left even in the very big guys. The mid-tier producers have been darlings of this bull market so far, largely because it was the majors who, to say it so, screwed things up so badly in the last bull market, right? Spent too much, growth for the sake of growth's sake, or growth for growth's sake instead of to make more money, too much debt, all of these things. So mid-tiers have certainly been darlings. These are some share price performances. They still offer, in terms of that context, a lot of really good upside going forward. So if you're a lower risk investor, certainly there is just good opportunity in majors and mid-tiers. Then there's the small and new producers. It's a small group because hardly anyone, the bear was so vicious that it annihilated most projects that were trying to get to production. But there certainly are some. The ones that survived are very good operations, right? They had to be to get through what we just went through. And small and new producers offer that duality of good outcomes, which is, provided that things go well, of course, and there's no black swan that takes the company out. But the duality of good outcomes is they could be taken out, or they could just become a nice, profitable producer on their own. Both of those are good in a share price perspective. So these are just two examples that are from my portfolio. Rox Gold, of course, built a really lovely mine during the downturn, entering production now, an enviable position for a company to be in. Caledonia is a tiny little gold producer in Zimbabwe, of all places, but they pay a dividend. Their share price has killed it this year, and it's because there's just not a lot of operations that are in that category. Stepping back a little bit, developers, again, most of them lost momentum completely in the bear market, so there's not a lot of developers out there as opportunities either. Those that are there are getting market love in a big way. Two examples from companies that are here, Integra and Atlantic. These are companies that are moving towards production, and like I say, investors love that, and there aren't very many options. Then, of course, the exploration side. We have a lot of exploration stage companies here. Highest risk, but highest potential for reward in the sector. So as long as your risk tolerance allows for that, then they're really fun, right? There's clearly ways to mitigate the risk there. One of them is just making sure that you understand what your necessary level of confidence is. You need to be able to sleep at night. So do you want to be in a play before they've done any drilling? Would you prefer to enter when there's at least been some drilling success and you're more on the, figuring out what that success means or expanding that? Do you like it, even farther down the road when, it's growing and you can wrap economics around it and the funds start buying in because the market cap gets big enough? Understand what your preference is for that so that you can sleep at night, because you can get good gains from all of those stages with a smaller company, but you need to be comfortable, reasonably comfortable with what you own. And then another one that I like to mention is this sort of new debuts. The early stages of a bull market are really marked by good teams, good people, geologists and executive teams who spent the bear market sitting, thinking, and then getting out and looking for what they're going to do to make it big in the next bull market. These are teams often who have done it before, who have a lot of experience, who understand what the context is and the timelines and the requirements for success, and they've gone and looked for and created new vehicles specific to this bull market. So some plans that got underway when things were still quiet are like New Market. Obviously, that was a huge success, taking advantage of inexpensive operating mines in the bear market, really improving them and now leading into a merger and sort of gaining 250% along the way. Ashanti is an example of a company that's here right now that's a well-connected and experienced team that has found a way to acquire some really interesting assets. This is people setting up for success specifically for the bull market that we're looking at. So these new debuts, they're unique to this stage in the market. So if you can find out about them, they're a really fun, exciting, and potentially profitable way to play this game. As you're looking for which opportunities to put in your portfolio, management is absolutely essential. And that's one reason that it's great you're here today. The guys and girls from these companies are all here. So spend time out talking to them. Obviously, there's things you can look up about them information-wise. You can look at what their track records are. You can look at what their, what successes they've had. You can understand what their vision is for the company and what their capital strategy is. But at the end of the day, these are the people who are managing your money if you become an investor. So you need to be able to have a conversation with the person and walk away from that conversation with the right feeling in your gut. I'm not saying that your gut's the best way to go, but it does matter. Don't ignore it. Pay attention. These people are spending your dollars and hopefully turning them into more. Entry points are also interesting. We're at such a entry point for the entire gold market right now that it's a little bit less significant today or in this next month than it is going forward. But as this bull market develops, as new opportunities come to you for assessment, pay attention to where and how you're entering, right? So have they done a financing 3.5 months ago that's about to become free trading and is going to impact their share price over the next little while? Usually free trading shares have a pretty significant impact. Is there news pending? Whether that's good or bad, do you want to get in before or after? If we're looking at stocks that are worth 40 cents and there's a 10-cent move based on news or free trading shares, that matters, right? So just pay attention to where your entry point is. And of course, if there's a financing pending, if you're an accredited investor, it's absolutely worth trying to get in on the financing if the terms look good. If you're interested in that, certainly come and talk to me more later. And then portfolio size. This is something that each person has to come up with on their own, but this space requires a fair bit of attention, especially if you're speculating with the earlier stage explorers. And the developers, to be honest. There's a lot of things that can go right, which is great, and perhaps you don't need to pay as much attention when they go right, but there's a lot of things that can go wrong, from a permit not working to metallurgy not working to a drill that misses, whatever it might be. In the exploration space, I would argue that you need to pay fairly close attention to the stocks that you own, which argues for a smaller portfolio simply because a huge one is very difficult to keep track of. Again, if you have people who are helping you, if you have a system for being able to keep up with all of your stocks, the size is obviously up to you at the end of the day, but I would argue that a manageable portfolio gives you the opportunity to realize that a share price has jumped and take some of your capital off the table, or be aware fairly soon after it happens that bad news has hit and react appropriately. So I would say pay attention to portfolio size. I guess that was my last slide.